building products that will reduce the volatility of the Bitcoin price in relation to currencies like the US dollar, to make it more attractive as not only an investment opportunity, but also as a unit of commerce, a unit of exchange. Currently, the US dollar is closely tied to the Bitcoin. It's the closest tied currency. I've included a slide here. It gives you an idea of the exchange volume. So Mt. Gox, as I said, is handling most of the trade volume, about 60%. And then you see 7% for BTCE. Mt. Gox Europe has got 6%. BTC 24 euro is 5%. What's interesting is Mt. Gox used to have almost 90% of the trade volume, and it's decreased to 60%, which is a good thing. It means that we're starting to see a little bit more variety and diversification in the Bitcoin exchange market. You can see that the euro and the US dollar are the two primary currencies that we've been seeing exchange with the Bitcoin in. But the US dollar used to be much, much higher, over 90%. So over time, we're starting to see more diversification in the currencies being exchanged for the US dollar, which is a very promising thing, because if this trend continues and more nations participate with the Bitcoin, it would be very easy for almost no transaction fee whatsoever to take your money, US dollars, and convert them into euros, or your money, US dollars, and convert them into, for example, the British pound. Why this is important is, remember a few slides ago when I mentioned that when you purchase your Xbox, a very complex series of regulations and money exchanges and other things have to happen. If we get a sufficient volume of Bitcoins being exchanged to other currencies, you could completely avoid that entire elegant, magical, super complex network of stuff and pay almost no exchange fee, which by itself adds a tremendous utility to the Bitcoin. Makes the Bitcoin a very, 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 very valuable service, because it literally costs hundreds of billions of dollars per year worldwide to maintain these kinds of exchanges. And if this can be done in a decentralized peer-to-peer fashion, it would the Bitcoin would be worth at least the minimum of that utility, meaning over $1,000 per coin. Okay, relationship to other currencies. Certain monies are going to always be tied together. The price of the Chinese currency, the yuan, the renminbi, is closely tied to the US dollar. And this is because China sells lots of stuff to the United States. And they need to make sure that when we keep buying their goods with US dollars, they keep printing money so their goods are cheap in comparison with our money, so that the commerce stays the same. Their factories can be running. This is why we call them a currency manipulator. It has impact on us, amongst other entities. So it's important, if you're an economist, if you're a trader, to understand which currencies are very closely tied together. The US dollar and the Iranian money is not very closely tied together. US dollar and the money of North Korea are not very closely tied together, because we have very strained political relationships with these governments and we don't trade with them. So whether the dollar goes up or down, it may have an indirect impact on the value of the Iranian currency or the value of the North Korean currency. It's going to have significantly less than, let's say, the value of the Chinese currency or the European Union's currency, the euro. Geography also has an incredibly important effect on the price of money. There's a relationship between the Canadian dollar and the US dollar because of the amount of trade, and also the peso in Mexico and the US dollar because of the amount of trade between our countries. That would not be apparent if Mexico, for example, was in the place of Argentina. Argentina's money has less of a connection to the US dollar than the peso does because of geography. And these relationships are studied by economists and by traders alike. And as I mentioned, there's a strong connection between the US dollar and the euro. It is, if you're good at this and you really like this, I'd highly encourage you to pursue a career as a professional trader, or at the very least as a economist. There's a lot of jobs in this field. They're very interesting jobs. You get to travel a lot and you make a lot of money. But if you're a trader, you're usually seeking to exploit patterns and trends for financial gain. Whereas if you're an economist, generally speaking, you're usually seeking to discover how economies tend to become interconnected due to trade, and then predict future growth or contraction. You also may be able to say, hey, we're too closely connected to this particular nation's economy. That may be in our nation's best interest to perhaps divest our closeness, to build some structures to say, hey, we're insulated in the event that this country fails. The banking crisis was so devastating back in 2008 when it collapsed our economy, and when it hurt our economy, it cascaded and rippled because of our interconnectedness to other economies and collapsed Iceland, for example, and has led to many problems in Europe that have resulted in problems in what are called the PIGS, Portugal, Italy, Greece, and Spain. Sometimes we substitute Italy for Ireland. But the relationship with other currencies is very closely studied. The relationship between the Bitcoin and other currencies is also closely studied. And what we see is the US dollar tends to be the most prevalent, has the strongest connection, I should say, to the Bitcoin. 75% of the Bitcoin exchange volume comes from the US dollar. Historically, by looking at the statistics, we've seen that the US dollar, when it weakens, that tends to strengthen the Bitcoin. However, most of the people who are currently invested in the Bitcoin are not institutional, sophisticated investors, so dollar weakening is not terribly reflected. It's not terribly well reflected in the price of the Bitcoin. Over time, as more institutional investors involve themselves with the Bitcoin, this dollar weakening trend will become much more amplified, similar to gold. Most interesting pattern seen is that if a central bank or a government takes actions deemed to be harmful to the holders of a currency, the Bitcoin tends to rise significantly. The most prevalent event was the Cyprus issue. And to refresh your memory, this is a case where Cyprus decided that they were going to start taking money from people's bank accounts, and the people in the nation were incredibly upset about that. So the Bitcoin people decided, hey, let's go ahead and move our money from this national currency and convert it into the Bitcoin, because there is absolutely no way they can freeze my account. There is no way they can do anything with this. They can't stop me from doing it. Once it's in there, it's my money, it's permanent, stable. And this actually caused a bubble. It resulted in the Bitcoin going up from about $20 to over $266 at its peak. So the Bitcoin benefits tremendously when governments do things like seize assets, propose wealth taxes, central banks start massive inflation, etc., etc. The Bitcoin also seems to be, interestingly enough, an economic combination of a gold-backed currency with the ability to arbitrarily divide, and suffers no political pressure whatsoever to behave in a certain fashion. So I mentioned with the dollar and many other currencies, a central bank is usually tasked with the mandate of keeping interest rates somewhat reasonable for the health of the economy, and also employment rates high. We don't like having 12% unemployment or 10% unemployment. So they say reduce unemployment to 4%, and they do this by currency manipulation. The Bitcoin is not tied to the welfare of a nation, and therefore it was never designed to be manipulated by other nation states. But this is problematic from an economic viewpoint, because all the models we've built over the last 100 years to understand how currencies work and do things interestingly, do interesting things, are not built in a way to reflect this behavior. So as of 2013, we really don't have good models. We really don't. And it's going to take a few years. It's going to take a lot of experimenting and experience and bubbles and busts to get to the point where we actually can model the Bitcoin in a reasonable way that people can understand. Finally, here's a metric I've invented called oligarchiness. In fact, we in the Bitcoin community have had to invent a couple of metrics to kind of describe our currency because of its unique nature. So oligarchalness comes from oligarchy. Oligarchy is ruled by the few. So in ancient times and even today, more often than not, governments tend to be influenced or directly controlled by a small group of very powerful people or entities. Currencies are no different. So a high oligarchalness currency is one that a small group of individuals, groups, or people have the ability to control that currency. through supply, control that currency through some form of manipulation. For example, China prints more money to keep their money cheap. They do this for trade. And therefore, a small group of people in China, the people who control the government, have the ability to either make the money more valuable or less valuable without any of the Chinese people's input or will. Low oligarchical money is money that's typically backed by a commodity. It's typically divorced from a central bank, and there have been many throughout history where it's really difficult for a small group of people to have a long-standing permanent influence over the currency. They may be able to temporarily manipulate the price, but this manipulation is not long-term. Low oligarchical currencies are not very common. They used to be much more common, especially when we talked about gold-backed currencies or silver-backed currencies, but over time they've been nearly ubiquitously replaced with fiat currencies that are subject to manipulation. And this is mostly because of the Bretton Woods Agreement, amongst other things that happened at the turn of at the mid part of the 20th century, because we decided that we were going to globalize, and having commodity-backed currencies made globalization very difficult. What's interesting about the Bitcoin is that it's actually right now a highly oligarchical currency. It has a small group of people, namely the people who are in charge of developing the Bitcoin open source software, the Bitcoin mining pool operators, and the leadership of Mt. Gox, the largest exchange, who have a tremendous influence over the price and the legitimacy of the currency. In fact, if all of these entities got together and decided to collude, they could destroy the Bitcoin if they so chose. They could just shut it all down, and there's nothing anybody could do about it. If there was enough devoted fans of the Bitcoin, they would be able to go ahead and restart it and repair it, but it would take years to fix the damage that these people could do. But there's good news. Over time, this influence has considerably decayed. When this first started, they controlled 100% of the market. They could do whatever they wanted. They could determine the algorithms, change the algorithms. But since they've said everything, and because the Bitcoin has become a global phenomena, they have lost a massive amount of control. Mt. Gox is now handling 60% of the trade. Within the next 5 years, probably 30 to 40%. The mining pool operators have become more spread out and more diverse. And they're from different countries and they don't talk to each other, so it's much more difficult for them to collude. And we'll discuss mining pools in Lecture 4. And also, the open source organization controlling the Bitcoin software has done it in such a way that the entire Bitcoin community would have to accept changes to the Bitcoin client. And outside of changes for security, reliability, improving the performance of the initial goals of the Bitcoin, it's very difficult for them. For example, let's say they decide to make 80 million coins the upper limit on the Bitcoin generation. To do that, it's nearly impossible. Some things cannot be changed as a result of decisions they made. So the oligarchalness of the Bitcoin is decreasing over time considerably. As more entities enter the Bitcoin ecosystem, the level will get to the point where it's almost immune to control or manipulation by any one entity. In fact, there's many people in the community, including myself, believe that if the Bitcoin survives for another 4 years with its current growth curve, it's probably going to be worth over $10 billion, and I'll discuss this more in the speculation lecture, because right now the entire Bitcoin market capitalization is about $1 billion, so we think there's going to be another order of magnitude growth in the value of the Bitcoin. But more importantly, nation-states will not be able to control the Bitcoin. Right now, if the United States so desired, for an investment of a couple $100 million, they probably could destroy the Bitcoin or significantly hurt the Bitcoin. Within another 4 years, because of the distributed nature and future adoption, even the United States government, with all of its money, power, and control, would not be able to significantly influence the Bitcoin without a mammoth investment, one that I don't think we would have the political will